Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. As founder and CIO of QVR Advisors, Benn Eifert spends his time looking for opportunities in volatility markets and helping his investors protect capital through periods of uncertainty. With the surge in volatility that has recently materialized in GameStop and a number of other stocks with high short interest, it was timely to have Ben back on the Alpha Exchange to share his always excellent insights on option market dynamics. Our discussion considers the emergence of a factor that may have been hiding in plain sight: crowdsourced convexity that left option hedgers short gamma. In the process of laying out this recent single stock risk event, Ben clarifies some of the misconceptions that may be common around the retail options trading community. From Ben's vantage point, some of these investors are hardly unsophisticated and understand leverage positioning and the feedback loops that can occur when dealers are hedging options from the short side. As we step back and consider the ecosystem of supply and demand for optionality in the equity market, Ben describes the losses that were imparted on short volatility strategies in March of 2020 and how that figures into a VIX that has been persistently high relative to the metrics it is typically related to. Lastly, given that 2021 has demonstrated that stocks can actually crash up as well as crash down, we consider the implications of GameStop on the volatility surface. Here, Ben sees good reason to expect a persistent extra premium to the upside call as a result of recent events. I hope you enjoyed this episode of the Alpha Exchange, my conversation with Benn Eifert. My guest today on the Alpha Exchange is Benn Eifert. He is the founder and CIO of QVR Advisors, a fund that specializes in volatility trading and is especially focused on helping its investors navigate through market risk episodes. Ben, thanks for being a repeat guest on the Alpha Exchange.
Hey, Dean, thanks for having me. It's great to be back.
Well, we sit in some unusual times, to be sure, both in the country, in politics, and certainly in markets, just as you thought things were getting a little strange. This onslaught of retail buying and participation in the market has taken an entirely new turn with GameStop and the copycats around GameStop. So we're sitting here on Friday and GameStop's closed at 315 or so, 325. Had a little bit of vol along the way. And I know you're an expert in variance swaps. So I wouldn't imagine what the price of a short-dated variance swap on GameStop would be, in the thousands, I assume. But let's see if we could just start from the top here, if you can, and I'm sure we'll have many layers to piece through here. But try to give us, from your vantage point, the big picture of what has occurred this week. And then I'd love to just try to get some of your perspectives on the implications, but what happened? That's the question.
So it's been, to your point, a wild week. At a high level, what you want to think about here is over the last little bit more than a year, we've seen develop a retail trading phenomenon that's been on a scale that we haven't seen for a very long time, that's analogous in some ways to the 90s, but different in some important ways in terms of the breadth of option trading, for example, among this retail community. That's something, again, really got going late 2019. Think of Tesla being a really popular name. It's a phenomenon that's heavily associated with online communities organized around message boards like within Reddit. You think of the Wall Street Bets group as being one of the largest and noisiest. And you started to see very significant growth in retail account openings, brokerage openings, funding of brokerage accounts starting late last year and really coinciding very heavily with the move first of Robinhood to zero commission trading and option trading, and then many of the other retail brokerages following on. And that really accelerated that growth of popularity of option trading in particular among retail investors. And you saw this big expansion of brokerage activity. And then within the pandemic, that really accelerated. And you can think of just many people becoming unemployed and many people working from home with a lot less supervision and sitting next to their personal computer and, able to engage in day trading type of activities. And so you just saw this steamrolling, parabolic move in retail option trading moving to levels that we've never seen. So you're talking about small trader customer categories in the OCC data, volumes being up 10 times over prior levels back a few years. And that phenomenon has moved around in terms of the interests of that community and what they're trading. So you think of, in the wake of the pandemic, that community focused a lot on distressed value opportunities. Think of cruise ships and Hertz, which had gone bankrupt, putting on a lot of long exposure and beaten up stocks that had gone very cheap on a dollar basis. A lot of that interest then rotated in the summer into mega cap tech. Think of like August and September when we had that really kind of parabolic move in mega cap tech and in mega cap tech balls. And then after that, a lot of the interest continued to build and rotate into a variety of, think of the software most shorted types of the unprofitable software basket type of things, where you look at Goldman's index and the performance of the highly speculative, unprofitable software companies just exploding. And then more recently with things like GameStop and BlackBerry, you're back into things that you would think of as historically as very beaten down names, very low dollar price stocks, GME being a company that's stores in old malls and things like that. And so you've seen this phenomenon grow and rotate between different interests in different themes and different areas. But I think the key thing to understand is there are many, many people in these kind of trading communities, and they're very diverse. And certainly many of them are just following on the popular bandwagon themes. But plenty of the folks engaged in this are evidently pretty sophisticated. I think just anecdotally from my own experience and my friends, I would say there's a great deal of the fourth-year investment banking associate and the law associate at a big law firm type of people in this, right? There's real disposable income and money in this crowd and understanding of financial markets. And, when you look at something like GME, like this was a very clear thesis that one gentleman has been laying out for a while about. He had his fundamental story for why he liked the stock, but also explicitly that there was very high short interest and that this was a very weak hands on the other side of this trade, and that a big concerted buying effort in that stock could push it up very rapidly. And so you see the kinds of tactics and thinking that you would typically associate with aggressive hedge funds in terms of understanding positioning in the marketplace, how to use options to get leverage and position aggressively. And you see this retail community behaving like that. And in GME, this is a very exaggerated example of how this can play out when there's a lot of money behind it. And the losses, what you ended up seeing was a variety of hedge funds that had big short positions in some of these names. So GME is the most obvious one. Very large short positions relative to the market and the flow to the company, and suffering very large losses to the point that it triggered cascading degrossing across the long short community and the platform community this week, really starting pretty aggressively on Monday. So that's, I think, the spillover to where you see very heavy selling in popular tech longs because folks are covering risk all across the board, right? And selling what they have. And you see big spikes in vol against popular short vol trades are being taken off at a lot of those places. So it's a fascinating daisy chain of events that really started, I think, with big losses in the hedge fund community on positions where they really got run over by aggressive, sophisticated retail investors, in my view.
It's really amazing. And you use the term daisy chain. I think that's an apt way of putting it in terms of spillover from this kind of corner of the market where it's got a bit of a casino flavor to it, but because it imparts vol to the market at large, essentially without even trying, people's books got bigger in the sense that the risk environment just got heightened. And so you wind up, as you say, with this degrossing event. It's quite interesting to see. You talked about the proliferation of the retail investor and options markets, and you started back in 2019 through 2020, and you talked about electronic trading and access to markets. Give us a sense for the kind of character of these trades, the attributes of the trades, just in terms of maturity selection. They would seem to be pretty focused on calls, not puts. And then how does the trade itself create a risk profile for the dealers, and how does that feed back into the markets? That seems like a topic of conversation as well.
The typical trades that these folks focus on, they're typically very short maturities, right? So in some cases, the expiring that day or the next day, a lot of the Friday weeklies in a lot of these names for a variety of reasons, right? But when you look at what's being discussed on Wall Street Bets, so these folks understand perfectly well the positioning that creates in the marketplace, right? So first of all, it gives them, maximum leverage per dollar of premium outlay because they're short-dated options, so you're not paying a whole lot for the vega. But then second of all, when you have, to your point, mostly upside calls, the call volume is 5-6 times the put volume typically in a lot of these contexts. GME had a lot of put volume go up once it started to go crazy, but the persistent trades that are getting put on by this community are more on the call side. And they're very aware that what that does is when you put dealers into very large positions where the customer is short a weekly 20 delta call, for example, and so the customer's long it, the dealer's short it, the customer's not delta hedging, the dealer is delta hedging. You end up in a situation where as the stock rallies, as there's continued buying pressure on the shares and continued buying pressure on the calls, dealers that you're moving up closer to that strike and that 20 delta call options becoming 30 delta, 40 delta, 50 delta, and the dealers having to buy. And there's a ton of gamma on those kind of options because you're talking about 3 days to expiry or 5 days to expiry. And so it creates this acceleration effect to the upside in the direction of where the big masses of outstanding strikes that are being bought are, right? And the way that this community trades, not that differently from, again, aggressive directional hedge funds, right? You get a big move in the stock rips up above a lot of the strikes of the open call interest, and you see the up and out 1x3 call roll going up, right? People selling out of their in the money calls and buying more upside, maybe the following Friday, redeploying their gains into bigger size and keeping that gamma to the upside and keeping that acceleration dynamic going.
There's another Greek that some people follow. It's a little more nuanced, but certainly something that you've, I think, talked about, which is they call it charm, which is delta as it relates to the passage of time. And I'm curious, just when people step back and they look at the market and the way it's effectively being rented through option structures at insanely high, I'm not saying that they're not worth it, but the volatility levels and the premium levels are incredibly high, justified by realized. But what are the dynamics as we've now gotten past Friday? We can just continue with GME. Of course, there's copycat type trades out there. But what are the dynamics as we've now just hit an options expiration? And I'm sure some of these options are deep in the money, but some of them won't be, right? Some of them are incredibly high vol options that are close to the money and might have been rolled, might not have been rolled. How should we think about the dynamics in terms of the dealer hedging activities that might emerge as this expiration peels off?
To your point, you get these big moves relative to where the outstanding strikes are and the strikes that are expiring, right? It's tremendously path dependent, right? So you get, to your point, if there's a whole bunch of outstanding upside calls with this rate of vol and this rate of decay, if we just don't rally, if we just stay here for a day, right, the delta on that big outstanding set of upside calls goes down, and that means dealers are selling, right? And so it's really this kind of path dependence effect of kind of the rally is self-reinforcing as long as there's enough buying pressure. If enough time even passes and the stock can't rally enough, that itself turns into selling pressure just through the passage of time. And then, of course, if some of those, you've alluded to this, but to the extent that there's still downside strikes in significant size, call strikes that we rallied up through that are still held down there and the downside still on the books, if we start to sell off, we sell back off down into those call strikes, and then they act as accelerators to the downside, right? So gamma is a two-sided phenomenon in that way. And yeah, the effect of charm, as you said, or delta decay, as we often call it, is out of the delta of out of the money options is just continuously falling towards zero, all else equal as time passes, and especially when you have these extremely high vol options. And so it creates this just very combustible mix of path dependence that can amplify these kind of moves to the upside or the downside.
So when we step back and look at GME and its proxies, but also the broader market at large, of course, the VIX closed at 33. Realized is nothing close to it. I think last we checked 1 month is maybe 15 or so. Is this delta decay concept in your mind especially relevant right now, just given option premium is being held on the books at a very high level, and you just got to keep the forward motion going just to keep up? Does it stand out to you as a special thing to watch at this point, or it's always a market factor and nothing really different this time around?
Well, certainly the higher vols are in the wings, the more that it's a factor, right? And so you look at GME, GME, what are the wings when vol is 600, right? In some sense, that vol surface is just really flat and really high. It's amazing, by the way, to look at, you see 600 vol and you see markets being made $160 at $162 at at the money option. I think I never would have guessed that market makers could have been able to handle this kind of path dependent risk on the other side well enough to be out there making 50 basis point wide markets in premium terms, right? And that tells you look back at the P&L of some of the trading houses on the market making side last year, and it tells you they've really learned how to anticipate this flow, how to risk manage this flow, how to understand every nuance of the path dependence of these positions.
That's a great segue to something just broader about the way in which liquidity is provided specifically in equity derivatives. I mean, that's a monumental feat to be able to quote a market that tight with vol so high and so much uncertainty. What's your perspective on just perhaps their advances in technology or in just the algorithms used to price vol surfaces? How is it that we got to this point of efficiency in pricing equity derivatives, even in pretty uncertain times?
It's an amazing contrast, right? Because you think even a couple of days ago, just in the S&P options, the 10 minutes coming into the close, you saw exchange prices going pretty wide. And certainly dealers' interest in taking a lot of risk, trading size, and in even something like S&P options with hedge funds was not particularly there. The contrast with something like GME, I think what it tells you is, first of all, very high two-way volumes are supportive of liquidity. And obviously that's sort of obvious in a sense, right? But you think of GME and you think, isn't the flow all one way? Aren't there only buyers? Isn't it all retail? Well, there are absolutely hedge funds trying to come in and sell calls and sell strangles, thinking this vol is crazy, this upside is overpriced. We hear about that every day, right? There's clearly buyers and sellers to see that kind of tight market. Second of all, it's absolutely a technology thing, right? So if you go visit some of the high frequency market making firms in options, their headcount is a technology headcount. It's not a trading headcount. And that's an industry that's become very consolidated. Even 7 or 8 years ago, there were so many kind of small boutique market making firms with, 10 people or 20 people in with their screens and their sheets and streaming quotes, right? That fragmentation has largely dissolved, right? Because it's just, you can't possibly compete in that environment. And now you're in a world where the big firms just absolutely dominate that market, and it takes incredible risk management and incredible speed, and also ability to understand when that flow is coming, where it's coming, and make sure you're positioned for it. Wall Street Bets just went quiet, but in terms of public access, but you better believe, obviously, the big guys know in real time what's being said about what ticker and what call strike on those message boards.
Right. Well, this is in some ways a historic event in the sense of we've now experienced, and perhaps we experienced some of this in the actual tech bubble, but the up crash. If you look at just the behavior typically of stocks, realized vol on down days versus up days, it's why the vol skew exists in the S&P, right? Markets go down faster than they go up, except this week and maybe in this segment of the market. And the explosion is so significant. I'm wondering if you can just give us your thoughts on just maybe the big picture implications, if you feel like there are any, of modeling of I think we talked a little bit before we jumped on about the vulnerabilities to these types of shocks to the upside now, whether you're in a short position or maybe short vol, short calls. These dynamics we haven't experienced, certainly not often in equity markets, and certainly not to this degree. What are the implications for option pricing from an event like this? Do you think they're long lasting, and what might they be?
Yeah, no, it's a great question. And I think there's a couple of levels, right? So I think the first thing that you can say with a lot of confidence is that certainly in any smaller cap, less liquid, single stock equity, you have to think that the right tail just stays relatively bid, that there's much more smile than there might have been a year or two ago relative to just pure skew, right? Because I think this kind of move has reminded people that actually, if anything, if you were to compare a long equity position and a short equity position, right, a long equity position is somehow inherently long gamma, and a short equity position is somehow inherently short gamma, right? Because when you have a short, it doubles and your size of your position doubles and you've got twice as much risk. And so especially in these low liquidity names, I mean, that can create this very volatile up crash type behavior, right? And you have to think when you don't know where that's going to happen next. So probably what that means is that there's just a persistent extra premium for upside in any kind of names where it looks like this type of thing could happen, right? I mean, you have to think about, okay, why is GME going up 150% some days and not some not Tesla, right? So Tesla is another example of a popular stock among this community, and it's gone up a tremendous amount over a long period of time, but a big day in Tesla is maybe 10 or 15%, not 120%. And the difference, of course, is that Tesla is a huge market cap, highly liquid stock versus something like GME. So you got to think that at that lower tier of liquidity, you just see profound reshaping of the volatility smile, where it's more symmetric, where the deep upside stays really big. Now, what about bigger names, and what about in index and ETFs? I think that's already been something that we've been talking about, right? When just think back to August, for example, right? When mega cap tech was really on the radar of a lot of this retail community, and also when you saw some big institutional trading of upside, right? So reported SoftBank doing some equity replacement trades and buying a ton of Vega. You had a market where the S&P and the NASDAQ were up double digits percentage with vol meaningfully higher. And that, if you have a long skew position, that's going to really hurt an index, right? And you've had this very unpredictable realized skew behavior in terms of spot down, vol up, or spot down, vol down, or vol up, spot up. And again, I think that the biggest thing that is going to imply, to a much lesser extent, I think, than, of course, in the super illiquid small cap stocks, but it's convexity, right? It's the wings, it's that smile curve not looking as nearly as linear arguably in the medium term future as we see how this all plays out, and more curved, and that deep upside, that 5 delta call wing trading at a premium to the 25 delta call wing, because getting caught in one of those big vol up, spot up squeezes short that deep tail upside can really hurt you. I think that will be, I don't know about a permanent feature of the landscape in perpetuity on the index side, but you could see for some extended period of time. It's very unclear that this retail phenomenon is going away anytime soon, right? We've talked about this a little bit, but I think you could see a very extended period of sideways, low volatility markets really shaking this crowd out, right? Because they're buyers of wingy premium. We sure haven't seen quiet markets in a while.
Well, you mentioned the dynamic that we certainly saw a bunch of last year, which is this, as you say, stocks up, vol up. Atypical. We've seen it occur during the tech bubble itself. I want to say from maybe 96 to 2000 was certainly a regime like that. And it really did come back last year. And you also brought Tesla in there. And that was probably the best example of a stock that did that. I'm wondering, just if you go back, and I know the first time we did a podcast together was shortly after it was sort of the crisis is just starting to de-escalate, so to speak. I think you were on in April of last year. And so there was a freshness to that calamity that occurred in March of 2020. And you're very close to understanding the losses that came in this risk recycling segment of the market from March of 2020. There certainly seemed to be lots of crystallized losses by short vol or convexity or correlation. How big a part do you think that plays? Maybe that some of the supply may have been taken offline. Is that in conjunction with this voracious demand from retail? Is that a part of why the VIX is up here in the low 30s and when realizes at 15? How much of it is a supply problem as well from your vantage point?
That's a great question. So I think it's unquestionable that a great deal of the supply, especially of tails and convexity, came offline after March, right? Some of the supply of near the money vol, I think to a lesser extent, right? I mean, I think you have to break up short volatility strategies and flows more broadly into one, you've got the sort of deep tail risk recycling or crash risk selling part of the market, right? Sort of capped versus uncapped variance and skew locks and things. There are very few people left who have the capability, or their boss will let them take that kind of tail risk, right? So, and that's very clearly leading to elevated longer-term convexity parameters, and probably will for some time. At the shorter end of the curve, really the dominant flows, closer to where the VIX you think of as a 1 month point, right? The shorter dated flows really were always dominated by big institutional call overwriting programs, put underwriting programs, and then the huge, more retail, high net worth focused iron condor programs. The iron condor stuff, everybody knows the big firms involved, and that got a lot smaller over the last couple of years and really did take some supply out of gamma in the front of the curve. The big institutional call right, put right stuff, the growth slowed down a little bit, but we don't really see that as having gone anywhere in terms of the kind of programs that people took 6 years to get through investment committee at the big public pension fund to put on. It's going to take another 6 years to take those programs off. And so you've really had this mix, right? Where I think that the shorter dated vol, really where, that 1 month point, we think there's still supply, there's less than there was. It's really the longer dated, more esoteric crash risk, the further out of the money stuff, where there's really a lot less supply. And I think you see that in convexity parameters, in variance relative to at the money vol. You see that in where the VIX complex trades relative to the at the money forward curve. And it's very plausible to us that it'll take a while for that to work its way through the system, because where are banks going to go to source new extreme crash risk in a world where there's so much headline risk? Investors in hedge funds now know a bunch of questions to ask that they didn't know a year and a half ago about what you might be doing. Risk managers at multi-strats figured out what sneaks through their systems and how to look for it, and how to make sure that their PMs aren't doing stuff. And the big pension funds that used to warehouse some of that risk, some of them are still doing a bit of it, but there were some very high profile blowups even within that community, right? And that was bad PR, and that leads to everybody else having less risk tolerance for the same thing.
You got to figure that at some point, if the positive carry from being short vol is significant enough and consistent enough, that capital will remigrate back, but it does feel like it's going to take time. And so in the meantime, you do have this tricky circumstance for folks that are looking to risk manage positions. And I'd love to get your take on how you're working with your investors on this, but it's not often that the VIX, and we'll just use that as a proxy for equity vol, is so high. It's got to be in the 95th plus percentile of all its observations. And it's clearing the market at such a premium to realized. You sort of get one or the other. The VIX can be really low, but the realized is even lower. So at least you're buying low implied vol, even if the carry isn't good. Or sometimes the VIX is high, but the realized spiked up even higher. And now we've had this concerted period of high VIX and big spread to realized. How do you take that in terms of what are the action items from a hedging checklist standpoint for someone like you? How do you sort of think about the alternatives? What should investors be thinking in terms of defensive trades in light of these challenging pricing dynamics?
So I think there's a couple of different things going on here. So the first one is you do want to separate VIX, which is the price of a 1 month variance swap, from at the money vol, and understand how much of that is pricing of tails versus how much of that is pricing of how volatile the market's been, right? And where pre-COVID environment, a 1 month variance swap might only trade 2 vol points over the at the money. In this kind of environment, that's 7 plus vol points.
Wow.
Right? So comparing VIX to realized vol isn't really what you want to do, right? If you want to compare VIX to something, you sort of have to square realized vol and figure out the variance swap calculation and everything, right? Because you lose a whole lot more money if you sell it and things go wrong. And that premium is now very high. The second thing is, even when you do that, if you were to look at trailing 3 month realize and compare that to where front month at the money is, to your point, you do see a pretty big gap there right now. Historically, for a decent period of time, that would have been not a great indicator, but at least an okay sort of statistical performing indicator of the cheapness of volatility, or like the forward-looking performance of a volatility trade. But if you look the last 5 or 6 years, that's gone, right? So there's no relationship between recent realized volatility risk premium, what is implied now, and what was realized last month, or what was realized over the last 2 months, and the forward looking, and what that realized is going to be over the next month, right? And I think that's really important. What's effectively happened is, or one interpretation of what's happened is that option markets have gotten more efficient about pricing in forward-looking near-term risk. You tend to see these buildups in what looks like VRP, where VIX is moving higher, at the money vol is moving higher, but realized isn't really moving, in anticipation of when the market all of a sudden is going to crash or start getting really volatile, and you see that signal performing. Right? And so I think it's really important to not overemphasize a recent, hey, realized vol was pretty low this month, and here's the level of current at the money. Don't you have to sell that, or you can't possibly be long protection. So that's the point. And then I think the third layer of it is really depends on what you're going for, right? For institutions that have large risk asset portfolios and are trying to solve for the long term and how they manage those portfolios and how they create good risk-adjusted returns over time. Usually folks like us aren't trying to help them do a bunch of tactical trading of very short-term options, right? Because it doesn't typically the basis risk is pretty high. It doesn't usually solve the problem that they have, right? Usually we're helping them think about longer term, slower moving hedge portfolios and how you rebalance between those hedge portfolios and the underlying risk assets that they own in an intelligent way to get good risk adjusted performance over time, right? And when you're doing things like buying 1 or 2 year options, the gamma versus theta component of it is a relatively small piece in the steady state, right? What you're trying to do is structure trades that are very convex in certain scenarios that don't have too much cost of carry and aren't too stretched of valuation levels.
One of the topics that has gotten some attention recently is the pricing of equity vol, VIX, the complex of metrics we look at for equities versus the sister metrics in credit markets, rate markets, FX markets. Equities really stands out in terms of the premium here relative to other markets. In your view, is that just a function of some of these very internalized dynamics that we've been talking about, the Robinhood effect and maybe some of the capacity constraints? Are there broader takeaways and are there opportunities maybe to utilize some of those sister markets from a risk management standpoint and hedging standpoint?
So it's a very good question. It depends on what you're really worried about. I think the first thing to keep in mind is certainly, let's take, for example, high yield credit spreads, right? CDX index, something like that. There's certainly a correlation between the level of the CDX high yield index and the VIX. What's the correlation? It's 50%, right? That's not a very high correlation, right? They are two things that if the world is ending, credit spreads will undoubtedly be blowing out a lot and volatility will be undoubtedly rising a lot. You don't really know the relative magnitudes exactly. It depends on what's driving risk. But the relationship is much, much sloppier than things internal to the equity market. And you can have localized equity market dynamics that are very decoupled from credit markets and very decoupled from interest rate volatility or other things like that. So I think that if your objective is to hedge a global meltdown scenario where banks are under pressure and companies are failing and it's a disaster, you're going to probably get pretty good value out of looking to the credit side, for example, for those kind of hedges. But there are a lot of scenarios you can imagine where equities maybe are down 25 or 30%, but you don't make that much money on those hedges because maybe it's just a lot of this kind of excess bid coming out of the market and volatility fading and some trendy, choppy downside over a year or two. And you really don't do well holding credit because it's not a big bankruptcy cycle. So I think you really have to solve this, triangulate the problem of what are your underlying exposures in your portfolio? What scenarios hurt you the most? What's that mix? How much basis risk are you willing to take in terms of the types of defensive positions you have in the portfolio? And what's the trade-off between that and the way that you think about values? I think it's a really important kind of conversation to have. I think that you really do have to get into that whole process as opposed to just looking at a chart and saying, oh, look, credit spreads are relatively tight compared to equity vol.
Yeah, there's typically a pretty good reason for these types of things. One of the areas that we really haven't talked about much is just the more macro considerations and how the universe of risk premium is priced. And I'm curious if you have views or the way in which it makes it into your process on monetary policy and rates. There are certainly arguments out there that the pricing of risk assets is very contingent on the continuation of very low rates. The Fed is trying its best to bring about a higher level of inflation, determined to overshoot, right? Go past 2% for an extended period of time. And yet the role of duration in portfolios is definitely getting a rethink as well. I think today is an example, Wednesday is an example with two decent S&P down days, and the TLT I think might have been down or certainly not up very much as well. So there's this question mark on a going forward basis as to the value of owning duration in the 60-40 portfolio, even as the Fed is determined to create this inflation outcome. Does that work its way into your process? I know that's very macro and it's very difficult to do much on the Fed watching side, but I'm just curious on those types of macro considerations. Are those a big part of your process or just things you follow?
Sure. I mean, I would say one of the biggest areas where those themes come in is just, again, on the solution side of our business. We have more of the commingled hedge fund side of the business and then the bespoke solution side of the business where we work with big asset owners. And I would say the most common theme really in the post-COVID environment, right, is that duration has become so unappealing to most asset owners. Looking at the 60-40 portfolio, big institutions we're seeing take 60-40 to 70-30 to 80-20, taking down fixed income and putting it into a variety of things, right? I mean, leaving maybe some cash, putting some into the equity market, putting some into private equity, maybe trying to roll some of it into alternatives and liquid alternatives. And really, it's that theme of yields are really low. We're not making any money on our fixed income portfolio. And we also perceive it to be a significant source of risk were there to be an interest rate breakout, or even just another episode of March where you remember how incredibly volatile and broken the fixed income market itself was, right? With munis and mortgages trading at incredible bases and even treasury and tips going wild at some point. So you've just seen this very strong appetite to reduce fixed income in response to the environment that we're in. Looking at the Fed on a go-forward basis, I mean, I think that and we were just talking with someone we work with closely on this today, it depends on where the interest rate risk is in the bucket, right? I mean, interest rate risk feels scarier further out the curve, arguably, because I think the Fed has signaled very consistently that, again, they've been undershooting their inflation targets for a long time. They want to demonstrate that they're serious. If inflation was to firm to 2% and to 2.5%, they're absolutely not going to scramble to feel like they're behind the curve and go raise short rates. They've been running too low for a long time. And they have a pretty credible commitment to keep rates low for some period of time here. But out at the back end, of course, the market can reprice risk premium and it can steepen yield curve and it can price in inflation expectations and all this kind of thing. To your point, I don't think we have a better read on the Fed than anyone else, but I think that the key role is helping investors understand where they used to have this 60-40 portfolio that had these really nice rebalancing characteristics, right? Where the fixed income reliably offset the risk characteristic of equities, right? Market would sell off. They're losing money on equities. They're making money on fixed income. They can rebalance. They can sell fixed income. They can buy equity and really get a very advantageous growth path of their compound returns from that. That's gone. And now the conversation is about, can you achieve something like that, at least with some similar characteristics with alternative defensive types of positions where you have convex tail hedges that you don't expect to make money on a go-forward basis on their own by any means. But under certain circumstances, if you're rebalancing between those positions and your core risk asset holdings can actually increase kind of those long-term compound returns because of protection of drawdowns and the opportunity to rebalance into those distressed risk assets on the lows.
Yeah, it's a great point on the rate side and just how much of an offset it can play in the next time around. I think it was Man Group, their work looked at the 6 biggest risk-off periods. I want to say they went back maybe to LTCM they might have started with. And in order to get the same bang for the buck the next time around, they're essentially saying the 10-year would have to rally to something like minus 50 basis points in yield. So I guess, again, never say never in finance, but it seems a long way away. So I want to thank you for the conversation, illuminating as always. I wanted to finish it and see if in Benn Eifert's world of thinking about risk and modeling was anything on the crypto front. Is the Bitcoin vol surface in your targets? Is that something you look at all, or is it something your clients ask you about?
It's something that always comes up in casual, fun conversation for sure. From a business perspective, it's not something that we touch or have taken a close look at. I think that it's obviously a very interesting emergent market with a great deal of volatility and a great deal of the same types of participants that you see in GME and so forth. With that, of course, comes quite a high degree of risk and a whole variety of new operational challenges. It's not the kind of market that I think in the near term, you're going to see a lot of institutions involved in adding alpha strategies in that area. But you do certainly see certain folks really trying to focus explicitly on that. And some of the old macro guys obviously have gotten very involved in crypto. But for us, it's more of an entertaining curiosity than an action item.
Well, we're getting plenty of vol in the equity market itself, right? So
that's right. Crypto is for people who can't take enough risk to get involved in GME.
That's exactly right. Well, Ben, I want to thank you again. It was great to catch up during this pretty unbelievable time. We'll see what next week offers as well. Again, I appreciate your insights, and our guests will be really enthusiastic to listen.
Sounds great. Thanks again, Dean. Really enjoyed it.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.